Hello and welcome back to another episode of the Blueprint Finance podcast, where we help Kiwis make smarter decisions about their finances. I'm Rory McSweeney, Senior Insurance Advisor and your host, joined with me by Daniel Lipman, Senior Mortgage Advisor and co-host, Daniel. We've got a hot topic today, Dan, and we've been going head to head on this one. We're going to talk about owning a home versus investing in the S&P 500 or similar.
This one's been on the list. I've been reluctant to do this one. It's part of the reason why I didn't do the intro, Rory. It's because I'm actually not too hot on this. I'm die-hard property.
Yeah.
You know, owning your family home is like a major cornerstone of building wealth. And, you're just here to come and shoot holes in that and undermine me.
Well, a little bit. I think there's sort of two parts to the conversation. There's numbers.
Yeah.
And we'll get into that. But then there's some more subjective elements around lifestyle and how you want to live your life, I suppose.
Yeah, absolutely. And some financial and non-financial decisions.
Yeah.
And then it's actually a really, really good case study on the science of investing and the psychology of investing. That
Yes.
I'll touch on at the end, but we're mainly going to focus on the numbers. I won't be a party pooper. I'm super excited about this. I actually love this conversation.
Yeah.
And we've got a really good case study to go through that I feel perfectly summarizes the cost benefit and the opportunity cost of each option.
Yeah, absolutely. Would you want to sort of lay it out to the listeners? What's the study? Give us a bit of an overview.
Absolutely. So whenever we usually do a case study on the potty, we give all the stats of the person. But what I love about you is you set up the initial part of the case study. They're living in Auckland, but originally from Dunedin.
Mate,
it's just a little sprinkle of Rory flair in there.
I spent 7 years in Dunedin. I love the place. And look, it's not all about Auckland. Well, this is an Auckland example, but our couple here in their 30s, they came from Dunedin to the big smoke,
You're trying to give everyone some representation. And I love that because that's what we're about, We help people all across the country, but they happen to be in Auckland for this example.
Yeah.
And we've done all the numbers, so you don't have to, the viewer. We've made all the assumptions and we've made it really straightforward and we've thought of everything you can think about. So maybe we'll go through some of these assumptions we're doing in this case study, comparing renting and investing in the stock market against owning your own home.
Yeah.
So the first assumption we made is that our couple, Jack and Jill from Dunedin, they've got $200,000 in KiwiSaver collectively.
Yeah.
So maybe one's got 100, one's got 50,000, but collectively they've got 200. That's their sort of nest egg for a 30-year-old couple, which is really impressive.
Yeah, they've done well.
Yeah.
They've done well. Carry on.
And they're looking to buy their first home or continue to rent, and they've come to us to sort of analyze the options. And so we're going to give them the full breakdown. We're going to give them the full summary. We've made some assumptions. So the purchase price is going to be $1 million.
Yeah.
All right. That's the average property price in Auckland.
Yeah. And they've got a 20% deposit, so they're getting the best rates.
Exactly. They're getting the very best interest rates. So that's a mortgage of $800,000 if they did buy the property.
Yep.
We're going to put the mortgage rate of 5%, average rate of fixed rate of 5%, which is pretty fair.
Yep.
And then we're going to assume the annual property growth rate of 5% as well, which is in line with the last 10 years and in line with the historical average. So
correct.
Some would say, everyone can agree that's an average return if we're talking about historical data in New Zealand.
Yeah.
And we're going to pay the mortgage off on 30 years. So no additional payments. We're just going to keep on a 30-year mortgage and see how that turns out.
Yep. Brilliant. They're also on $200,000 household income.
Yep.
So the nuts and bolts of it are they've got an opportunity to buy their first home, take out an $800,000 debt sell their souls to the bank,
Mate,
which we love. It's not selling your souls to the
get
bank.
into their home.
Or, on the contrary, turn that KiwiSaver into a high growth fund.
Yep.
And start a little bit of an investment journey. And we're going to map out, these guys are 30. So we're going to map out what the next 35 years look like. Scenario 1, which you'll talk about, is home ownership. And then I'll talk about their investments.
Yeah, absolutely.
There's a few other numbers to run through here. Do you want to give us a high level about this difference, this investment fund that we've created and how we've got there?
Touching on the investment fund. So we're comparing it to the position being in KiwiSaver, right? So they can't access those funds, but they're going to be continuing to contribute to this. And the way that we've structured it to be a very fair way is to say, okay, look, as soon as they buy the property, there's a discrepancy between the cost of owning and the cost of renting. Because if you are a mortgage holder, not only do you have to pay your mortgage, you also have to pay rates, insurance, and property maintenance as well.
Yeah.
So we've assumed costs for that, $4,000 rates, $3,000 insurance, and $100 a month on maintenance. And these costs, excluding the maintenance, will increase at 3% per year with inflation.
Yeah, correct.
Now, your rent cost is $700 a week. So it's there's a big difference there. It's about $440 a week difference in terms of owning and renting.
Yeah. Yep. So that's the money that we're going to do some projections around if they invested that difference.
Exactly. Yeah.
But we've actually mapped it that over time that difference diminishes, and then at about 20 years it flips.
Yeah.
And it becomes cheaper to own your own home.
Yeah.
So we're going to factor that in as well.
Yeah.
Without
why
going through
that?
all
Why
the numbers
is that?
over the years.
Why is that?
Yeah. Why is that?
I'm asking you.
Listen, mate, I
You're
haven't done
Mr.
my
Rent
homework.
Vest.
I haven't done my homework, mate.
So it's because the rent increases every year. Rent increases at an average of 3%. So yes, it's all nice and fun to say now, oh, renting's cheaper than owning, so I'm better off. But you have to consider the fact that you buy this house and you're stabilizing your property costs.
Yeah.
You're nilling out your future costs.
Yeah,
right?
yeah, that's right. We've actually done the same increase on things like insurance and stuff, but they're obviously smaller costs.
Yeah.
As a proportion to rent.
Exactly.
So when rent goes up 3%, that's a higher increase than insurance, which is $3,000 per annum, or rates.
Exactly right. Yeah, you're exactly right. And then we've also assumed the S&P net return is going to be 10%.
Which is quite generous.
I think it's fair for the assumption. If we're assuming 5% for property growth, I think 10% for the S&P is pretty fair.
Yeah, true. Yeah. True. It's all relative. And if you want to run this type of example with different numbers, like more conservative, if you like.
Yeah.
Then be our guest.
Totally agree.
Can I start off with the first scenario?
Of course you can. Yeah, of course.
This is wild. $200,000. If you crank that KiwiSaver up, now this is not the S&P 500, but this is just KiwiSaver going into your Milford Aggressive or whatever the case may be.
They do a 10%, yeah?
They do a 10%, yeah.
Yeah.
So in 35 years, that 200K is worth about $6.6 million. There he is.
Oh, I spilt my cuppa.
I think that's wild.
Isn't that crazy? Yeah. Isn't that crazy? Because I think people can't actually comprehend how crazy that is. Obviously, we've managed KiwiSavers via Jono. We've seen some big balances, but to think about folks who are in their 30s now and have 6-figure balances, what they're actually going to be.
Yeah, absolutely.
Crazy.
And this is not factoring in contributions.
Yeah.
This is not factoring in income growth, 4% employee plus 3% employer
That's
contributions.
if you just left it.
This is the $200,000, yeah. So $6.6 million. The investments, and we'll get back to the intricacies of this later, but they come up to about 3.3. So
that's what you're putting into it.
Yeah. So the first 20 years, the additional.
Yeah.
So this is not KiwiSaver contributions. This is the rent versus owning difference.
Understood.
About $3.3 million at age 65. So rent your whole life, Come 65, not including your KiwiSaver contributions,
Mm.
we'd in fact the thing is the same both sides. $9.9 million.
That's what you're left with.
That's what you're left with at the end of the day.
That can't be right.
Mate, that's absolutely right.
Wait, is that after 35 years? That's in retirement.
Yeah.
9.6 million. 9.6.
Okay.
Still a massive amount, but you will realize why that's an important figure. So say that again. It's after 35 years, 9.6 million.
Forgot that we had to be so precise with this.
Yeah, of course. Yeah, we do. It's a precise.
I was $300,000 in my favor.
Yeah, exactly.
Yeah. So it's $9.6 million. I retract my earlier statement about 9.9.
Yeah.
But jeepers, that's a hell of a lot of coin, mate. Now,
I mean, that gives you options, doesn't it? On retirement.
So many options.
Yeah. No, look, hey, let's get all the information out there and then we can actually have a discussion. So
I wanted to hear what you've got to say.
Yeah. No, that's fantastic. So that's the option of renting and investing. So the key things to note: initial investment $200,000.
Yeah.
In year one, you're putting in $449 a week. That slowly diminishes as your rent increases and you can't afford to contribute as much.
Correct.
Year 20, you're putting in $0. And then it actually swings the other way where you've got more cash flow as a homeowner after 20 years.
Yeah.
Right? So that's the option that we're going to look at now. So for the home buyer, you're starting off, obviously you're paying $449 more to own your home, but you've neutralized the ownership cost or your living cost. All right. That's a good thing. Now, what benefits do you get? All right. You get a place to call your own.
Oh, we get into the benefits early on. This is brilliant. Okay.
I just can't help myself. No. But I genuinely can't help myself.
Yeah.
But you get to start reaping the benefits of home ownership, right? Yes, it's more expensive initially, but you have your property, and with property comes proven appreciation. A 5.5% annual return, leveraged return. You only put down $200,000, but your property is growing at a 5.5% interest rate. You know,
that's right, and you're paying
so your real return
per week.
Yeah,
but you're building equity as well.
You're building equity. Every payment you're paying off some principal. Okay, so those are two of the major things. And yes, 5.5 is a lot less than 10%, but it's a leverage return. Remember that. So
hey mate, why pay off someone else's mortgage when you can pay off your own? Mate?
Yeah. Exactly. Finally, someone talking sense. So in this method, okay, time goes on, it all looks really good, and we get into 30 years down the track, and
pretty old.
Yeah, we paid off our mortgage. Yeah, 30 years and we've paid off our mortgage.
And what's your house worth?
So year 30 comes along, you're investing in your investment account, and now you're fully paid off your home. So you can take the full mortgage payment and invest that into your investment account.
Yeah, for 5 years.
Along with that extra amount you had to cover the rent discrepancy.
Yeah.
Year 30 comes around, you are, significantly better off net worth wise if you invested.
So in every way.
In cash flow way, all those sorts of things.
I want to know at age 65, what's your house worth and how much cash have you got?
Year 65, I'm retiring. I've had 5 years mortgage free. My house is worth 5.52 million.
Freehold. This is the same $1 million house you bought in the year today.
Yes.
It's now worth 5.52.
And I've got an investment account of 940,000 as well.
Mate, and you've only been spending $100 a month on maintenance, and we're 35 years later.
Yeah, easy.
You're obviously doing a lot yourself.
Yeah. Oh, big DIY.
Yeah.
Yeah, $1,200 a year. You save that up, that's a whole roof, you know?
Yeah. So you've got a $5.5 million property, $940,000 in cash. Again, we're excluding KiwiSaver contribution, so you have more.
Yeah.
I've got $9.6 million in cash.
Mm.
That's $3.14 million in my favor. But that's you just buying, holding your first ever property.
Yeah.
So, I mean, in real terms, that doesn't happen, right?
Yeah.
So have you got another scenario for us? Because I know when we did these numbers, it stung a little bit.
Look, the numbers did sting, and I appreciate you giving me that opening. But what I want to say before we move on is that you're completely right. Home ownership, paying the minimum on your mortgage, and just doing the bare minimum, it doesn't make sense if you just compared to fundamentally investing in the stock market that's returning 10%, investing with Milford that's returning 10%. You're going to end off financially better off renting. But if you approach your home ownership properly or with some intent, you can end up far, far, far better off by being able to use that leverage to buy property, because leverage is like a time machine. And property allows you to do that, you know? So even with this example, just with the family home, I feel like if we redid it a bit, I could probably make it look a much better. But I want to leave it there, and I want to say, look, you've won round one. So shake my hand. You've won round one.
I actually have a few thoughts on this scenario that we haven't talked about. Obviously, we started with that 200K in KiwiSaver, and that's sort of like in the fortress, if you like.
Tucked away.
Which is good, because investing can be an emotional roller coaster.
Yeah.
You know, with 20 or 30% in bad cases, or more if we go into real depression, swings in the market.
Yeah.
So when you've got a big portfolio in the millions and you're seeing 30% swing, that takes a toll.
100%.
So the home ownership is a smoother ride, I would say.
Yeah.
And you've got a lot more lifestyle factors. So lifestyle is subjective, and some people would like renting and the freedom to be able to move, et cetera, and not be tied down. But, you know, we talked about DIY and fixing things up and stuff. We haven't even factored that in, because, I mean, you've sat there for 35 years and you haven't put it in a new kitchen. No, the house could be looking great. I'd hope you've done something to it in 35 years, or else, you know, you're living in a shack. But anyway, this is just a purely numbers chat. There's other variables.
I mean, I think we should touch on the psychology before we move on to this, the final scenario. And yes, totally agree with you. Probably need to be a bit more higher on the average maintenance cost, because you will have to replace a roof after 35 years. Unless you bought it with a brand new concrete roof, you probably get 50 years out of that. But let's assume it's probably a bit more. It's probably more like $200 a month or $300 a month, you know, which will increase the gap that you can invest. But there's a psychology of investing, you know. If we look at some statistics of people who make their mortgage, you know, people pay rent like it's religion. People pay their mortgage like it's religion. You know? Less than 4% of mortgages at the moment are in arrears, whereas it's less than 10% of Kiwis invest regularly into investment accounts. You know what I mean? This model is expecting people to be investing this really decent amount of money, like religion, into their investment accounts. And
in good times and in bad.
And especially in bad. Because as anyone would know, after seeing, you know, buying the dip, that sort of term come around, that is the most important time to be investing. Literally, when you're getting everything at a discount, that's what gives you the average 10% return.
That's right. Yeah.
You know?
Yeah. That's what John said it on an episode. I can't remember his stats, but let's just say if you missed 10 of the best investing days in the year, then your returns significantly impact.
100%.
Yeah.
Whereas the property locks in that gain. You know, you just have to make your mortgage. Versus consistently investing. Say you run into financial hardship, or, you know, you don't want to start spending your account, but you can't make that investment. You have to cut back the investing.
Yeah.
Completely destroys the model.
Yeah,
You know?
that's right.
But it doesn't mean it's not possible. I'll completely tip my hat to you. It is possible.
Yep.
Um,
And to that, we talked about this earlier and we're talking about now. I said, if the person in the investing scenario lost discipline and they dipped into their investments, or they just didn't do it for periods of time, or maybe they just lived a more lavish lifestyle for that period of time, they'd still have $6.6 million from that 200,000
from the KiwiSaver.
Just in that fortress. And so I guess that's a good lesson around, if you're going to do an investment strategy, if you're having discipline around it, obviously KiwiSavers does it for you. But it's still a huge amount of money, eh? Like the house deposit just left in a growth account is really interesting to see.
It says a lot about, in Australia, for example, you can't access your super for your first time. It says a lot about that sort of mindset that the financial advisors and the government have put in place.
Well, that's super interesting, right? They've mandated it and they made it a law.
They've mandated it,
because someone doing the calculations suggested that the people will be way better off long term.
Yeah.
So it won't give them the option.
And for the layman, I think they will. The layman will, but the proactive investor, who are the people that we hope are our clients, and the proactive homeowner, that people hope are clients, will outpace that regardless.
Yeah.
So with my secret sauce, which I'm about to share right now. So, mate, this is what this is what I live and breathe for. This sort of Uno Reverso card I'm going to show you now. What happens if at property 15, we dip our toes into a little something called property investing?
Yeah, at year 15.
Year 15.
Let's dip those toes in, mate. Let's dive in, actually.
Mate, I'm so excited about this because, this is what I live for. And this is the most exciting thing about property ownership, I think, is that the fact that you can actually utilize your equity. We always talk about your invested money like soldiers, going to work for you. Your equity in your property is the exact same thing. You can access those dollars and redeploy them in the property market, with the similar rates, with tools like interest only and all these incredible, powerful things we have to use leverage. So let's look at our property owner, right? We'll revisit the exact same scenario. Year 15, I'm far behind you. You're building wealth like it's just going out of fashion. You're investing like clockwork.
And you've just sat back for 15 years, just
paid my mortgage,
painting a few rooms, paying your mortgage. And now you've gone to get some advice and you are equitied up to your eyeballs.
Yeah. I've gone to see the boys at Blueprint and they said I've got some equity. Okay. The future advisors in 15 years, maybe not, maybe I'm retired, but Jack Hammond has said,
you'll be retired in 15 years.
Jack Hammond has said, you've got some equity. So the family home at 15 years in is worth 2.08 million. So it's doubled in value in 15 years.
Nice.
The mortgage balance remaining is 540,000. So I've paid off a decent whack. I paid off 260K. So I've got total equity of 1.54 million. You can borrow up to 80% of your family home to access the equity. So I've got usable equity of 1.12 million. That's my usable equity.
Yep. It's a fair chunk.
I've got money to play with. Let's say the income has, been increasing with inflation. I'll definitely have income for servicing. And let's say the boys at Blueprint have told me to target some high yielding cash flow properties.
60 cents on the dollar.
Yeah. I've got Jack advising me, telling me exactly what type of property to buy. And I can buy 3 properties.
Yep.
On paper, I could actually buy more if I wanted to go full, but we're just going to buy 3.
Yep.
For the example, to really show the power of investing.
Yep. But stick within our
now,
means.
Our advice, and this isn't tax advice, but after dealing with hundreds and hundreds of investors, how we structure it is the family home stays on principal interest. That is a debt you pay off. And all of your investment debt will be in interest only.
Okay.
We're not paying off the principal on our 3 investment properties we're buying.
Yep. Okay. We're looking for capital growth.
We are speculating for capital growth.
Speculating.
No, that's what we're
Alright.
doing, right?
Okay.
Let's be
Yep.
honest. For the long term, though,
Yeah.
we're not saying we want to buy it and sell it in 5 years. We're going to hold these for 20 years and sell them on retirement.
Beautiful. Cash out.
So let's say they're cash flow neutral. Obviously, you're going to have to do some work, maybe maintenance, all that sort of stuff, but they're cash flow neutral. We considered a cash flow top up of $300 per month total.
Mm-hmm.
Deducted that from the investment, and we let that grow. So in year 35, we started off with total property value of 1.8 mil,
Mm-hmm.
3 properties worth 600K each. 35 years later, they are worth 4.77 million, 5.5% annual return, just like the family home. Right?
Magic.
And what have we done? We've used our equity. Obviously, it's tough being a landlord these days, but we did it, you know? We held the property, we rented it for 20 years, and now we've let inflation do its thing, you know? The market's risen. Incomes have gone up, so property values have gone up. 20 years later, we can sell these houses for 4.77 million.
Yeah, that's magic. And that's easy done, right? You're giving people advice on this all the time.
Yeah.
Yeah.
100%. So we've still got some debt on them, right? We're paying that debt off.
This takes a little bit of psychology as well too, because some people get into the mindset of like, I just want to pay my mortgage off and not have their money work for them, eh?
Yeah, exactly.
But this is really good. This is completely achievable. You've had plenty of equity. Realistic example, you can go and buy these 3 rentals, interest only, and get that capital gain. And now you're looking at a retirement sum of what?
9.79 million is my net worth.
So no wonder I couldn't have said 9.9.
That's what I was so weird about.
It was 9.6, wasn't it?
Yeah. So I've outstripped you by what is that?
190,000.
Yeah, 190K. I'm happy. Whew. So there you go.
Different ways to get to the same outcome.
Different ways to get the same outcome, yeah. And I suppose you could lean into each more, you know? There's an argument for that. If I'm investing, does that mean you should be putting more cash into the S&P? But
you can take more risk with your investments. We didn't talk about that.
Yeah, you could take more risk with your investments. But you could also buy more investment properties on the counter argument, you know?
Sure.
Because the equity just continuing to grow. My equity position is really strong. I could have bought 9 rentals instead of just the 3.
Yeah.
So that is how the numbers look.
You've really had to clutch at the straws there at the end in that round 2, eh?
Yeah. I would really like to lean on the key points though. Like, yes, the numbers look better, but I just don't trust the psychology of the everyman to be investing like clockwork for 30 years, you know?
Yeah.
I trust people to make their mortgage. I trust people to build equity and then have options with that equity, you know? So I'm backing the family home option all the way. And there's so much more you can do with it. You know, you don't have to pay your mortgage off in 30 years. You should pay it off faster. You should find ways to pay it off faster, you know?
Yeah.
So that is what I'm backing. And I hear what you're saying, but I just disagree, mate.
Nah, fair call, mate. I'd like to run numbers, or perhaps hindsight. We should have on because the $6.6 million was protected from that $200,000 house deposit.
True.
If we had people topping up to a 10% contribution, so leaning into the fact that people aren't disciplined per se, so like drop it in that KiwiSaver vault where you can't touch it.
Yeah.
And look at that, because if you could get to age 65 and have anywhere close to $10 million in cash, the lifestyle that you could have at that point, like, and it's probably not for everybody. Some people want to settle down and have roots, but you know, I talked about you could go and live 6 months in Croatia and 6 months in Bali and
Yeah.
here, there, and everywhere, and never be fixed to an abode.
That's true. That's true. And it opens up this great conversation about how wealth building is not, it's a science because it's a blend between logic and personal preference.
And what you want. Yeah.
And what you want. Yeah. Because exactly like you said, some people just love having an asset that appreciates, and yes, they have to maintain it, but they don't really mind. It goes up in value and they can use the equity in the future, and it's the family home, you know? Versus maybe more of a nomadic approach where, you know, we don't mind having to move around every couple of years and change rentals and these sorts of things, you know? And that's the beauty of modern finance, is that there's a solution for both, you know?
Absolutely.
Even in saying that, there's a solution for the renter to buy an investment property, you know?
Oh yeah, the rent vesting case is a good one too.
Yeah, rent vesting is really interesting, and we got lots of clients who do it. And some people who, especially very popular, is those who buy investment properties and live with their parents, for example. You know, that's a super common one.
Where it would get interesting is like, you know, this young professional couple, $1 million home. Next stages of life could be family.
Yeah.
So the townhouse or the small 2-bedroom that they purchase in central Auckland, they've outgrown. So realistically, if they're homeowners, they're actually now looking for that next home.
Yeah.
And that sometimes requires more equity.
Yes.
To stick with that 20%. And perhaps less barriers if you're able to find a new rental, and lower cost in terms you don't have to have that additional equity.
That's true.
It might cost you more per week.
Yeah.
Really got me thinking this case study. You know,
it's
obviously home ownership is a Kiwi. It's in our DNA.
Yeah, yeah.
But there's certainly some people out there that are doing things differently, investing and then or just investing and renting.
Yeah.
And like you say, it's different strokes for different folks.
Yeah, and I think it's a good reflection of the opportunity with diversification, you know?
Yeah.
I'm a massive investor in shares as well, and I thrash my KiwiSaver too, even though I've got multiple properties, you know? Because I see the benefits either way. Property's been really stagnant for 5 years. S&P and international markets have hit an all-time high, right? So it's a blend. I mean, you've got to expose yourself as much as you can. When you're starting out, obviously, you really got to concentrate. You know, if you're trying to save that first home, you can't be still investing. You really got to knuckle that deposit. But once you get yourself set up, you can always do a bit of both, right? Which is super important.
Yeah, absolutely. Really enjoyed this one. And
it's been fun, man.
I guess the conclusion, we've already sort of summarized today, but, you know, 2 scenarios we looked at, they're almost neck and neck. And they're both great outcomes in reality.
That's right. They're both great outcomes in reality, and it comes down to personal preference. What it does tell us is obviously, first, the importance of owning assets. You know, over time, you must own something to not grow wealth, but keep wealth, you know?
Yeah.
And number 2 is just diversify if you can.
Absolutely.
Yeah. And pick a strategy and stick to it.
Yes.
Yeah.
Do something, don't do nothing.
Yeah, exactly. Thank you, mate.